What Has Worked in Investing, a publication by Tweedy Browne Company LLC, an analysis of undervalued securities and the historical indicator of exceptional returns. Benjamin Graham, along with David Dodd at Columbia Business School, published security analysis that defined value investing. Tom Knapp, who worked with Graham, brought his principles to Tweedy Browne. Knapp condensed Graham's principles and focused on high growth potential long-term value holdings. Knapp's influence brought about Tweedy Browne's value investment strategy. These 6 characteristics yield good criteria for value investing. These 6 characteristics are low price in relation to asset value, low price in relation to earnings, a significant pattern of purchases by inside officers and directors, a significant decline in stock price, small market capitalization, and a high dividend yield. In the following slides, I will discuss in more detail these 6 points. Low price in relation to asset value means stocks with lower market prices in relation to their inherent book value will indicate a discounted price for the security. The market price will inevitably reflect the inherent value of the security. Low price in relation to earnings mean that stocks with low PE ratios have greater potential for stock price and earnings growth. Pattern of insider purchases don't necessarily mean insider trading. Often inside officers and directors who have conviction about their company and its future success will buy more stock at low prices to yield short-term or intermediate returns. The officers may have insights about unknown assets, new programs, new product development, or other increases in value of the business not reflected in the market. A significant drop in stock price gives an opportunity to buy stock at a lower price with expected statistical mean reversion. In other words, stock price is expected to return to its historical mean throughout surges and drops in price. A drop in price allows a buy point that will yield a positive return. Small market capitalization is often a characteristic of high growth potential companies. They typically have more specialization and have higher probability of mergers and acquisitions than large capitalization stocks. Benjamin Graham was made famous by his tactic of only purchasing stocks priced 66% or less than the book value. Henry Oppenheimer conducted a study that supported the success of this tactic. His study showed that over a 13-year period, value stocks yielded 29% return compared to a market return of only 11.5%. So the question is, how consistent is this method? The following studies from What Has Worked will show supporting evidence that Tweedy Browne's characteristics lead to historically higher returns. This study, by Robert Davidson, published while at Yale School of Management, shows over a period from 1967 to 1984 that low price-to-book value stocks yielded higher returns than those generated by high price-to-book value stocks. Warner DeBont and Richard Thaler found that low capitalization stocks combined with low price-to-book value yielded significantly higher returns. Another interesting point is that Tier 1 and 2 yielded returns lower than market in the prior 4 years. This reflects the decline in price characteristic I will discuss later. In the same study, lower price-to-book value stocks had higher earnings per share growth than comparable high price-to-book value stocks. As you can see, in lower price-to-book value, earnings per share was declining prior to selection date, whereas in higher price-to-book value stocks, EPS was increasing through selection date. Lower price-to-book value yielded higher returns in most of the time frames as shown in the study conducted by Tweedy Browne. The only case where there was an exception in high returns was the 6-month period. Over a 3-year period, low price-to-book value stocks significantly outperformed high price-to-book value stocks. It is important to keep in mind the long-term nature of value investing. This is a parallel study by Tweedy Browne for unleveraged companies. As you can see, the results are the same. In a study by Eugene Fama and Kenneth French while at the University of Chicago, small market capitalization in conjunction with low price-to-book value yielded consistently higher rates of return. It is interesting to note that only the highest tier for price-to-book value stocks, when combined with small market capitalization, resulted in inconsistent yields compared with the other price-to-book value tiers. William Sharp, Carlo Capal, and Ian Raleigh from Union Bank of Switzerland found that value stocks internationally outperformed growth stocks considerably from January 1981 to June of 1992. The 2 lowest outperforming countries, being the US and Germany, only outperformed growth stocks by 16% and 18%, respectively. Low PE ratios consistently outperformed higher PE ratios, as found in a study conducted from 1966 to 1984 by Sanjoy Basu, published in the Journal of Finance. Drummond Value Management, along with Michael Berry of James Madison University, found in their study that low PE ratios in conjunction with small capitalization outperformed large capitalization stocks and high PE ratios. In a series of studies, credentials can be found at the bottom of the slide, stocks with insider purchases yielded considerably higher returns than the market. Focusing on the years of the studies, we must consider these results in part to be influenced by insider trading. Insider trading and its legal ramifications have been a relatively recent establishment. This being the Insider Trading Sanctions Act of 1984 and Enforcement Act of 1988. DM Power and A.A. Lonnie conducted a study that concluded that stocks experiencing a downturn in stock price yielded higher returns after those years than comparable stocks with better past performance. Lastly, in a study by Michael Kepler, higher dividend yields corresponded to higher returns than comparable lower dividend stocks. As stated by Tweedy Browne, stocks typically had all the characteristics if they fell into at least one of the initial categories. As evident from the selected studies, it appears that, consistent with the hypothesis, undervalued stocks meeting Tweedy Browne's criteria yielded consistently higher returns. Historical correlation, however, does not give us the power to foretell the future. Tweedy Browne concluded that despite the obvious trend, picking stocks is influenced by a variety of factors not unique to value investing, including risk assessment, liquidity, and growth potential, to name a few. But these studies do show that Tweedy Browne's 6 characteristics provide a great starting point for research, not the end-all be-all of investing.